Okay, Jackie. We're known for being loquacious or talkative, and this is an episode where we definitely got carried away with a great topic on the 72T exceptions and SEPP plan. You may not think it's appropriate for you, but we encourage our listeners to listen to the entire episode, right?
Yeah, because for sure, and you love to use your acronyms, the SEPP is substantially equal periodic payments. That is only one way to get money out of your retirement account, the $459.5 without penalty. That is one of the biggest problems for an early retiree. So we go through all the different exceptions, and then we dive into and really highlight the 72T that a lot of people are afraid of, even professionals. So we found an expert. He wasn't anywhere on social media, but we found an expert that spoke to every single question we had that is going to be so valuable for our listeners.
Yeah, this is a manifesto. This is a treatise on the 72T. We break it up into 2 hours. We encourage you to listen to the first hour. Take a break because it's going to give you a little bit of brain overload, and then there'll be another hour on the 72T and other topics a week from now.
Yeah, this is definitely one of those reference episodes. Me as a big podcast listener, there's certain things that I bookmark or I save where I can go back and actually reference because it had so much information. This is one of those episodes, Bill, we could call it the Catching Up to Phi University or Catching Up to Phi 201, but there is just so much information here and we don't like to slight our audience. So if we got more questions, we're going to keep talking.
Well, this is applicable to that audience that starts late but wants to finish early like you, and we go over your case study basically. So say you start at 45 and you want to retire at 55. The 72T is a perfect bridge for you to 59 and a half, and you'll find out why in this episode. So stay tuned. Here it comes.
72T is a section that is essentially crafted in reverse that says, hey, you got a 401k plan or you got an IRA account, whatever it is. You, when you take money out, will always be subjected to the 10% surtax, unless you qualify for an exception. Okay, and so the first exception is the one we all know about. Wait until you're 59 and a half. That one's easy. We got 19 more to go, of which 16 or more I'm going to call transaction-oriented, meaning event-oriented. It is when you are dealing with your overall family economic unit experience, and whether you're in the business of selling labor hours, or whether you're switching over and you're now going to say, I'm stopping the sale of my labor hour. I'm going to instead devote creating a replacement income stream so I can pay the mortgage, go to the grocery, etc. You best be looking at exceptions 4 and 5. Starting with 6 and running through 20, are they worth looking at? Absolutely yes. 72Ts are rule bound. You can only use these formulas, and you gotta be equal, and you gotta do it for 5 or more years, and quite honestly, you sometimes get sick of the rules. What we've got here is a rule set that probably the first word you think of is fixed, and it's true. Your financial life is variable. It's not fixed. What you've got is oil and water, and they do not mix. So I think the value added here is pre-building flexible moves to address either the opportunities or the crises that are going to face you in a future year that you do not know about today.
Welcome to Catching Up to Phi, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. I'm Bill Yount with my beautiful co-host, Jackie Cummins-Koski, and for our beautiful guest, who we'll introduce here in a minute. But Jackie, what's going on in your world this week?
Oh gosh, I got a lot of stuff going on. One thing I didn't talk to you about is that I am going to be going to Bali with Amy, and I'm going to be speaking. So I've got a big trip coming up in September, and I'm excited about that.
Well, that's very exciting. I love it. I love it. You go to all these fire events.
I love them.
Since I'm still a working stiff, I can't get to Bali on that timetable. But congratulations. That'll be a great talk. It's very exciting. Here in Knoxville, it's raining, and I'm just excited to have a day off from work to talk to our guest, Mr. 72T. Jackie, why don't you take a moment to introduce him to our audience and then tell them what we're talking about today?
Yeah, this is a new person that you may not have heard about, but I think I mentioned to you, Bill, last year I set up my own 72T, which simply means I was able to get money out of my retirement account early because unlike you, I am not 59 and a half. So I found this guy that answered every single one of my questions. And I'm like, we have to get him on. So during this process, like I said, I was digging for anything I possibly could find. I came across a website called 72T Calc, C-A-L-C. So I found out who was the creator and I said, you know what? I chatted with him on the phone and I said, would you mind coming on the show? And he barely knew what a podcast was or the FIRE movement, but he was willing to entertain us. So today we are thrilled to have a true expert on early retirement withdrawal strategies joining us, Bill Stecker. He is a CPA since 1980. I think I was in high school, maybe. And the visionary founder of the website called 72 Calc, which focuses obviously on IRS code 72T, and we'll be talking all about that so that you know what that is and you're not scared of it. So it basically, like I said, allows you to take money out of your retirement account without a penalty. So I consider Bill Stecker one of those hidden geniuses, and I'm so glad that I found him. But with decades of experience in tax planning and retirement strategies, Bill has become a trusted voice for anyone navigating the complexities of early retirement. His innovative tools and insights on his website have helped countless individuals unlock their retirement funds without penalties. Today, he's here to share his knowledge with us and help us lean into and solve a common problem for early retirees that many other professionals shy away from. So Bill has spent over 4 decades in accounting, finance, and tax-related fields. Further, he has particular in-depth knowledge around the 72 Ts, having made many successful private letter ruling requests and determination letter requests, which we never ever hear about, but he's the guy. So he's done all of this, and he's here to enlighten us today. So Bill Stecker, welcome to Catching Up to FI.
Thank you so much for inviting me. I hope going to be an enlightening process for all your listeners, and hopefully I'll have less stage fright as we move through the process today.
Well, we love having podcast virgins on the show. And Jackie went with him and got him the right equipment, did a practice session with him. And it's often not the case that we meet somebody of your maturity who has never done a podcast. But honestly, I had never done a podcast until I was about 55, 56. And when I started listening to them in the early 50s, I didn't know what they were. So it's okay. And my mother has never listened to or been on a podcast, and she's 87. So there's still a generation out there that just sort of said, that's for the younger generation. But look at you. You're adopting technology even at your mature age. So I'm impressed, and thank you for joining us today.
Okay, where would you like to start?
All right. Well, we got a lot. Now, because both of you guys' name is Bill, I am now giving you my favorite nickname, Bill Stecker. I'm giving you the nickname of Mr. 72T so that I don't get you mixed up. And you have so much expertise, so much knowledge. I'm like, we need to bring that to our audience, because this is a topic where so many people shy away from, even professionals, even CPAs, even CFPs. So let's start sort of in the beginning. So you specialize, like I said, in this topic that some people are afraid of. We'll talk about the basics of a 72T, but then we're going to talk about all the other ways that you can get money out of a retirement account before you turn 59 and a half. Because even for our late starters, let's say they wake up at 40 or 45, they could easily get to where they are ready to, or they have set themselves up to be able to walk away and live off their investments within about 10 years. That's what happened to me. That's what happens to a lot of people. So they still could be younger than that 59 and a half like me. So that was a problem that I have. So that we can right off the bat take away one little fear and confusion, generally tell us, what is a 72T, this IRS code?
Okay, I'd like to just spend 3 minutes on history.
Okay.
This is all coming out of the late 1970s, early 1980s. So we only have about 40 years or thereabouts of tax history, which is short compared to other portions of the Internal Revenue Code. And it's all 401k, 403b, IRA, profit sharing plan oriented in the defined contribution department. I'm sorry, but for about 90% of your audience or greater, the defined benefit plan is dead, which was work for one, maybe two employers, and at age 60 or 65, you get a going away party, a gold watch, and $3,247 a month. It's gone because employers can't afford it. And so what we've got instead now is defined contribution plans, and that's what Code Section 72T is all about. Now, there's some 20 exceptions in today's world that permit early distributions from defined contribution plans without fear of surtaxes and interest and penalties and so forth. And we can get into those when you tell me you're ready to hear about them. Number 4 is substantially equal periodic payment plans. That's a mouthful. And I think the core of what we want to be focusing on today, but let's recognize that there's also 19 other exceptions, some of which aren't too nice, but at least they work. And so as it relates to, sometimes people just say, I'm going to launch a 72T plan. And my first reaction is, well, is that 1 or number 17? And what they really mean is number 4. And going down that path, unfortunately, exception number 4 has the title in the Internal Revenue Code, substantially equal periodic payment. And you read it and you go, well, that's good. What does that mean? And Congress back in 1986 said, we don't know. They handed it off to the Joint Committee on Taxation and they said, we'll think about it. And then they said, IRS, go figure it out.
That's interesting because I think this is a great tool for those, say, in the 45 to 55-year-old age group, which is a large portion of our audience. And we'll talk later about segregation of your IRAs. But this tool can allow you to go part-time and use your 72T exception 4 as part of your income and continue to work and have that as the remainder part of your income. So people need to listen to this episode. It's going to allow you to semi-retire.
The breadth of reasoning is amazing. And I would actually stretch, I think you're right, the core is age 45 to 55. Give it 2 or 3 years in front and give it 2 or 3 years on the back. And I find a client base that is extremely diverse. And the first observation is none of them need lessons on the advocacy of savings. They were taught that before they were teenagers, usually by their family environment. Now they're caught in a bit of a box, being told on the one hand, well, you really can't touch these balances until you're 59 and a half. And on the other hand, they say to themselves, but wait a minute, I have different sets of middle 40s to middle 50s objectives where I either need whole or at least part help to go do something different than, I'll say it, stay in corporate America for another 10 years.
Well, that's interesting because why 59 and a half? And is there a real reason behind that? And what are the implications of 59 and a half?
Well, number one, that's one of the great mysteries of Congress. No one will own up to coining 59 and a half, though there are some hints, twofold. One is there is some federal literature that related to the federal retirement plans from the 50s and 60s that had 59 and a half in it. Another version is when you're 59 and a half, you are actuarially 60. Okay? So that no one will own up to being the author of 59 and a half. I've looked, can't find it, but it got stuck in Code Section 72T. So
what that functionally does is leave your money in sort of 401k or IRA jail. And we need to get out of jail free card. And that's what we're talking about today, right, Jackie?
Yeah, absolutely. And I feel that way. So Bill, you mentioned the sweet spot for maybe setting up a 72T would be around 45 to 55. For me, I did it at 55 because obviously, and we'll talk about the particulars of a 72T, but you have to continue it for the greater of 5 years or until you're 59 and a half. So if you're 35, you got a long time, but I was 55. So all I'm looking at is like 5 or 6 years, right? So that makes a difference. And that's why I think that, I agree with you. That's the sweet spot. So Mr. 72T, you said there's almost 20 different ways or exceptions that will allow you to get money out of your retirement account before you turn 59 and a half. So we're going to dive into the 72T part, but now we know that that's not the only thing. We're going to talk a little bit more about what are those other exceptions, because these may be the right fit for some of our audience. The 72T might be the best fit for others. So if you're listening to this, we're going to talk through these, but if you're on YouTube, we're going to just show this list and I'll include it in the show notes as well. So let me go ahead and show this list and let's talk through them and maybe highlight some of the ones that are the most important. So what do you think is the most common or one of the most accessible ones to people in terms of getting money out of their retirement account early without penalty?
72T is a section that is essentially crafted in reverse that says, hey, you got a 401k plan or you got an IRA account, whatever it is. You, when you take money out, will always be subjected to the 10% surtax, comma, unless you qualify for an exception. Okay, and so the first exception is the one we all know about. Wait until you're 59 and a half. That one's easy. We got 19 more to go, of which 16 or more I'm going to call transaction-oriented, meaning event-oriented, that are in the general gist of things unpleasant. So exception number 2, there's no penalty if you're dead. And so you say, well, that's pleasant, but it doesn't affect me. Exception number 3 is permanent and total disability. Only slightly better than exception number 2. Then you go to things like exception number 7. If a judge orders a tax levy on your assets, there's no exception. Well, how did you get there that you've got a tax levy? Big medical expenses. Quadros, those happen when husbands and wives split paths.
That was me. When I got divorced, I did have a quadro where my ex-husband's employer, they got a court order. They had to split it up. I didn't realize at the time, but there was no 10% penalty. So I could have taken money out. I didn't. I rolled it over and
Sure.
I'm glad that I did. But yes. So what does quadro stand for?
Qualified domestic relations order.
Okay. We got to speak English sometimes because I would say that to people. They're like, what does that mean? Okay.
Very
Thank you.
simply, it's a sitting judge listening to a divorce proceeding. And usually both parties have agreed and present a document to the judge that says qualified domestic relations order. It's about 3 pages long. And he basically looks at the attorneys for he and she and says, you guys all agree on this quadro, right? They say, yes. And he signs it. And it becomes a court order, which is ordering someone, some trustee, either from a company 401k plan or your IRA is trusteed at, say, Fidelity or Vanguard or wherever. They're being ordered to take the assets and chop them up and put them in different buckets.
You know that fantastic feeling when life just clicks, when you feel fully in control and on track? Well, Boldin Planner makes that happen. Their software is right up there with some of the professional planning software I've used as a CFP professional.
I recently started using Boldin, previously known as NewRetirement. It's the closest thing to a fortune teller or a magic wand that you'll find in real life. The tool turns your dreams into plans and your plans into reality, whether it's funding college, retiring early, or knowing that you can help your aging parents. Boldin gives you the answers you need to achieve your goals.
Well, with Boldin, you'll make the right decisions. Run any what-if scenarios and see how your choices shape your future. What if you paid off debt faster? What if you invested more this year? Boldin breaks it all down and you'll make confident, informed choices that help you catch up to 5.
With Boldin, you are in control. No more guesswork or second-guessing your decisions. Boldin gives you the financial know-how to understand your options and take charge of your future with confidence.
Ready to get started and get on track with the life that you want? Head on over to go.boldin.com and then /catching up. That's go.boldin, BOLDIN.com/catching up. So I have a question, Bill, clarification. So I thought the quadros were only through an employer-sponsored plan. Are you able to do this with an IRA? Or is it called something different if it's an IRA?
If it's an IRA, it falls under a spousal division of assets.
Okay.
It has the same effect in that,
gotcha.
Let's just face it, in the 21st century, divorce, A, is common. B, I believe essentially virtually all states have passed some version of no-fault divorce.
Right.
And so by the time this whole issue gets in front of a judge, what we're really talking about is division of assets and stabilization of income, particularly when there's minors, kids under the age of 18. And so quadro is kind of a generic word for the court stepping into the situation, remembering that a divorce is a state action, whereas exception number 9 here is federal statute. And the feds have basically said, when the state courts get involved, we want to be uninvolved. Let the states take over and do what's right, and we won't, at the federal level, interfere with surtaxing and penalizing distributions.
Okay, gotcha. And this list that we're looking at, it does have a column to identify, are these workplace plans or qualified plans?
Right.
Does it apply to those or does it apply to an IRA? So on this list, the quadros is saying no for IRAs. But again, if it falls in the federal, then that's why that's got a no. But we will point out, as you talk about them, if it's different for an IRA versus an employer workplace plan. So let's keep going. What else you got?
Probably of the yes and no's here, the number one, most important, is number 5, which deals with separation of service. And here, there is a legal distinction between a qualified plan, of which there are lots of different kinds. We all call them just 401k plans. That's good enough. And IRAs. If you separate from service at age 55 or later, and the asset the target assets are in the plan, you can make surtax and interest-free withdrawals directly from the plan to you, and it's okay. All you need is a cooperative plan administrator. And so that generally will break down into two groups. Small employers really tend to run 401k plans from a defensive perspective. I have to run this plan for employee retention purposes, but I really don't want to be in the plan administration business. Conversely, big plans with thousands and thousands of employees will tend to be run by big professional entities. And by the way, the top three are Fidelity, Vanguard, and Schwab. I mean, they're so big and they're so good at it that they will permit more features in 401k plans than small ones will. So, whereas, remember, we talked about substantially equal periodic payments being number 4, there's going to be a whole bunch of detail rules we'll get into in a little bit. What's nice about exception number 5 is no rules. Just take the money. And it becomes taxable income in the year you distribute. So that if you attain 55, you don't even have to be 55 yet. In the year of distribution, first year distribution, it's going to come out no problem. All you got to do is ask for it. It's a much better route than exception number 4 because you don't have all of these techie rules to work with. Furthermore, if you're a first responder, 55 becomes 50. And first responders are all police, all firemen, FBI, DEA. It goes on and on and on.
Does that include doctors and nurses?
Yes.
Oh, look at that, Bill. So I have another question for you, Mr. 72T. So I wonder, it's too bad that a lot of employers, or I've heard from some people to say, yes, I know about the rule of 55, which is what it's commonly called. Yeah. But they would say, well, my employer doesn't allow that. Now, my employer, it wasn't one of the biggest ones, but it was Empower, which is pretty big too. They did offer the rule of 55. Now, I left at 49, so I didn't get to use it. However, in your experience with your clients, how common is it to have the rule of 55 as part of the custodian's plan at an employer?
I think you're asking how often do I find it applicable?
Yeah, well, it would have to be written into their summary plan description, correct? Or summary plan agreement.
Generally, yes. In that, there are documents that are hundreds of pages long that no one ever wants to read about plans and trusts. Okay? Throw them away. That all gets reduced usually to a document. It's called a summary plan description. 15, 16, 18 pages. And so the real question is, who's the plan designer? Plan designer is almost always the employer. And are they an employer of 50 people or 5,000? And so they're taught in the latter case, they're speaking with who's an administrative professional, and a group of people who are going to be the trustees and custodians and administrators of the plan. And they literally go down a checklist and say, do you want this feature in your plan? Yes or no? Ding, da, ding, da, ding, down we go. And one of them is a separation of service withdrawals starting at age 50 or 55. And it's a yes or no checkbox. And if they check it yes, boom, it's in the plan. And if they check it no, it's not. And literally, if they checked yes, and you're, like I said, you're a first responder and you're over 50 or you're over 55 and you're talking to me, our conversation is free and very fast. You don't need my services. You go use this other exception. You're good to go.
Okay, that's good to know. So that rule of 50 or 55. Bill Young, I knew about the rule of 55. I didn't know the exception for at age 50 if you're first responder. Did you know that, Bill?
Yeah, this is an important one because if you've been a saver as, say, an emergency medicine physician and done well, but you burn out and you want to access your retirement plan because you know what, I can't do this anymore, then this is a great rule for early retirement of physicians, nurses, or anybody that's gotten it right. It wouldn't necessarily be a great rule for the late starter population, but I had not heard of this as you asked, and it's a great rule to get out there. We got a few more to go through so we can spend the second half of the show on the 72T. And we're at number 10, Mr. 72T. Can you take us down the rest of the list? And there's some new ones we want to touch on too.
They're so new, they're not even in the guide yet.
Well, one of the most interesting things to me was you have terminal illness, domestic abuse, the federally declared disaster areas that might have been always, maybe we can talk about that for a little bit, but the $1,000 emergency fund.
Yes.
So those are just a few, but I guess, so which one of these are just through an employer plan?
The latest ones are available to both. They can be yes, yes.
Good to know. Yes, yes. Okay, gotcha. Okay, that's really good to know. Okay.
And so, for example, the latest starting at 15 is this emergency expenses, which only kicked in last year, 2024, where you can take $1,000. Small amount, very transactional, and even, so what's the definition of emergency?
Right.
We don't even know yet. Because, as is often the case, Congress comes up with good ideas, or maybe not so good, depending on your perspective, gets a president to sign it, and it's law. And then they hand it off literally to the general counsel's office of the Internal Revenue Service and say, you guys figure it out. And they just haven't gotten around to it yet. Similarly, domestic abuse expense. That one's a little easier to figure out in that you're probably paying some sets of professionals that are in the domestic abuse business, and it's capped at $10,000 a year. Terminal illness, similarly, fairly easy to figure out, I think, and that would be some physician or group of physicians has basically stamped your patient file as terminally ill, or more obviously, you might be in hospice, and that exception would apply. Next, federally declared disasters. Again, not too different, and up to a pretty big cap, 22 grand, which will likely get indexed, is my guess, where you're either in a federally declared disaster area. Let's pick on Florida and the Carolinas and California and so forth. And you can essentially, those are all federally declared disasters, and you can get at your monies, again, without surtax. Last but not least is going to be long-term care insurance premiums, but that doesn't kick in until 2026. And again, give Congress a little bit of time. I bet you they can find 2 or 3 or 4 more new exceptions in the next couple of years. I think it is when you are dealing with your overall family economic unit experience, and whether you're in the business of selling labor hours or whether you're switching over and you're now going to say, I'm stopping the sale of my labor hour. I'm going to instead devote creating a replacement income stream so I can pay the mortgage, go to the grocery, etc. You best be looking at exceptions 4 and 5. Starting with 6 and running through 20, are they worth looking at? Absolutely yes, just to make sure you haven't overlooked something that might be pertinent to you, and we'll get into this in a bit, there's logic to setting up multiple IRAs, and the 2 most frequently used additional exceptions are the healthcare and the education expenses, because those tend to be big bubble bucks kinds of problems or opportunities. And so you go grab those dollars out of a different IRA. while keeping a quote unquote a 72T plan, which is kind of like a perpetual income stream running from a base IRA or two.
And then the last couple are also interesting too, because home purchases these days are becoming more expensive, and you can take out money from you can take it out from an IRA, but not your qualified plan with your employer in order to purchase or put your down payment on a home, correct?
Yeah, 10 grand, first time purchase only. First time purchase, I think I'd have to go back and look, means you didn't purchase a home in the last 5 years.
Yeah, I feel like you as a CPA know more than me. I thought it was 2 years, but we're going to include that into the show notes. And we'll figure out who's right. And I would say the CPA might be right, but we'll include that in the show notes as far as technically how long do you have to have not purchased a primary home to qualify for that. All of these, by the way, have bells and whistles, certain qualifications, certain nuances, like the higher education. Higher education is another one of those where you cannot do that through an employer plan, but you can do it through an IRA. And the same thing for health insurance premiums. Right. I guess I have a question about the health insurance premiums. So if you have an IRA, you can use that to pay health insurance premiums. Can you elaborate on that?
Sure. If you recall your own tax return, and most of the time you walk through the steps of doing what's called Schedule A, itemized deductions.
Oh, okay.
Yeah, gotcha. Same rules are going to apply as the Schedule A itemized deductions. In that to qualify for this exception, two things have to happen. It needs to be a qualified medical expense, number one. And that has pretty broad definition, and I think we all know what those are. The second test is it has to be qualified medical expenditures in excess of 7.5% of your adjusted gross income. That's the first little subtraction in that top section on the Schedule A. And so then all kinds of medical expenses. I don't care what doctor you paid. I don't care what hospital you paid. I don't care whose premiums you paid. And whether you're a cooperating premium in a corporate health insurance plan or whether you're already purchasing through, I call them the state auction medical plans, all of that are considered qualified medical expense. And you just total them up. You subtract 7.5% of AGI, any excess with unlimited dollars comes out under this exception.
Okay, so I got a quiz question for you, because obviously you can only take advantage of that particular thing if you itemize your taxes, okay, versus taking the standard deduction. What percentage of people, let's say in 2024 or 2023 even, what percent use the standard deduction versus the itemized deduction on their taxes? Bill, you can't answer.
About 80%.
All right. So Bill is raising his hand. What was your answer, Bill?
It was going to be 90%.
Well, I'm going to believe the CPA. So Bill Stecker, you win.
I don't know that we need to debate the real difference there.
So the point is, right, that most people do not itemize, so they may not be able to take advantage of that. That's why I wanted a little more clarification. And I guess the last two that I think are worth mentioning are qualified reservists and childbirth and adoption. Both of those would apply to an IRA and a workplace retirement plan.
Yeah.
Right?
Those are new ones.
Okay. Those are new ones.
Is it possible to take a portion of your qualified plan, roll it over into an IRA, and then use this for the ones that say no for the qualified plan?
I'll give you a qualified yes. In that, a couple things would have to happen. One, generally speaking, I don't care what kind of qualified plan you're in order to get a buck out, you have to separate from service.
So the old qualified plans would be amenable to this, right? And we bounced jobs. So the old ones, I guess you could do this with.
Theoretically, yes. Then let's say you don't need all of it. You just need some of it. Then again, you need a cooperative plan administrator. Let's say you have 50K sitting in a, let's call it a dormant 401k plan from 20 years ago. And it's just sitting there. It's invested in however you've so directed it. And you say, oh, I want to use an exception that's only available to an IRA. Your choices would be essentially twofold. One, you've already separated from service, so that old 50K 401k balance is mobile. And you can either do what's called a trustee to trustee transfer of 100% of it from 401k land to IRA land, or you can just do part of it depending upon what the plan administrator tells you.
Okay. Well, there's just like HSAs, there's lots of little hacks, tricks, and loopholes.
Yeah, it is.
And we may be getting into the weeds, but I think this has been very important. Jackie, we should probably move on to the 72T, as that is the crux and the meat of this presentation today, right?
Yeah. And like you said, it was worth going through these because we're not saying that the 72T is for everybody, but let's kind of hit other things that you should look at in order to make this type of decisions. That's what I had to look at. Mm-hmm. So Mr. 72T, we'll get into the different criterias of setting up a 72T, the different options, but I guess initially would be, how does one determine whether or not the 72 makes sense to them? How do you approach it with your clients? Let's talk about the planning and strategy around doing something like a 72T.
Probably the easiest way to think of it is you have been through a progression of paid jobs somewhere. And in today's world, you almost collect deferred accounts as a collection in a file drawer. And they can be private companies, public service, 403B plans. They're just all over the ballpark. Think of saying, I'm going to take this whole menagerie of account types and I'm going to shove them all into an IRA account. One IRA account. Pick the brokerage of your choice. And there's the money. $400,000, $600,000, $800,000, $1 million. It is what it is. And you've accumulated all of those assets in one place. Our first step is to do a piece of real easy math. And by the way, earlier on, you were talking about people are afraid of the mathematics here. Don't be. The fear of the math involved is nonsense. Almost everybody today runs a personal computer. Almost everybody today has got Microsoft Suites or Microsoft 365 or even uses some Google products, which are nothing more than toned down Microsoft products. It's the equal PMT function in Excel. Gives you everything you need to know. And you put in an interest rate, you put in a term, which is your life expectancy, and you put in the dollar amount of the IRA. And it gives you a number back, which is about, in today's operating environment, is right around the 6 to 6.5% of the total IRA becomes your ceiling qualified distribution. So let's say you have 800K, your ceiling's 50K. We figured that out in about 12 seconds.
Right.
And if that fits, maybe we continue to have a conversation and do some additional planning. Conversely, if you say, I'm sorry, I need $100,000 a year to make my family function as an economic unit, my response is, I can't help you. Go get another job.
Well, you're right. The math part can be pretty easy, and I will drop this in the show notes. But Sean Mulaney, he's another friend of the show. He's a young CPA. He's a young buck compared to you, but he's a smart guy. And he has a YouTube video that he did showing how to use a Google Sheet in order to calculate your 72T. I just copied that over and I started with that. And then there's a bunch of other online calculators, and I'll drop the ones in the show notes that I use. So you're right. The math part, very doable, has become very easy. And again, we'll step through some of the other nuances. So you take them through all those scenarios before you ever arrive to saying, I think the 72T is the right fit for you.
Yes, and I want to add on a new concept that 72Ts are rule bound. You can only use these formulas, and you got to be equal, and you got to do it for 5 or more years. And quite honestly, you sometimes get sick of the rules. What we've got here is a rule set that probably the first word you think of is fixed. And it's true. Your financial life is variable. It's not fixed. What you've got is oil and water, and they do not mix. So I think the value added here is pre-building flexible moves to address either the opportunities or the crises that are going to face you in a future year that you do not know about today. And if you start working the puzzle, and it is a bit of a puzzle palace, we can pre-build flexible moves so that, let's take it, a real obvious one, a family member has a serious health emergency that is you either don't have insurance or you do have insurance, but for whatever reason gets classified by some insurance company as not covered. It's happening every day today. And so you say to yourself, well, I'm sorry, I can't pay for that medical set of procedures. That's not one of the alternatives that is in your vocabulary talking to your family. And maybe you have to cause $100,000 or $250,000 to appear to pay the right folks to solve the medical crisis. How do you do it? Well, if you have just one IRA, one distribution plan, you're probably stuck. If you have 2 or 3 IRAs and you have reserve liquidity, and reserve liquidity also takes on multiple attributes, it says, oh, I can either make a big dent in this crisis, or maybe I can completely solve this crisis, all the better, without disturbing the 72T plans I started 3 years ago. Keep them running, keep them safe so that surtaxes, interest, and penalties don't apply.
What you're saying here actually is very important. And the way I understood it from your book is you've got to calculate your fixed expenses, your baseline fixed expenses, and you can 72T those in one IRA, and you can use the second IRA as your variable expenses, where these big swings in your expense needs can be taken from. Is that correct?
That's very close to being correct. Whether you use fixed variable or whether you use uncontrollable controllable, I think you get to the same buckets of expense annually and through time. But yes, exactly that. And then also I'm suggesting the need for a third bucket. The third bucket could be a third IRA. It could be just an after-tax brokerage account from your investment efforts of previous years. A third bucket for liquidity could be you own your home, but you have a standby home equity line of credit for $300,000, which you have not used because nothing has presented itself that required its use. And so in today's world, I literally suggest that we tackle 3 different buckets. The first 2, more often than not, are IRAs. Number 3 can be a mixture of other stuff so that we can handle what life brings us without disturbing buckets 1 and 2.
Yeah, so basically you're saying don't 72T or SEPP your entire IRA, because that leaves you vulnerable.
Exactly.
So I have an additional question. So a lot of times as an alternative to a 72T, especially if it's somebody a little bit younger, they will incorporate like the Roth IRA ladder. And I know that kind of you have to, it has to season for 5 years when you do those Roth conversions. But do you have any, I guess, thoughts around the right time to use a Roth conversion ladder versus a 72T?
I believe that let's just take all of the qualified plan stuff, the 401ks, the 403bs, the traditional IRAs, and there's been a consistent message actually coming from the government as well as employers, as well as the whole financial press. And that message has always been save early, save often.
Right.
And you will be blessed with a nest egg of a material size, let's just say somewhere in your 50s. Okay, that sum of assets and the way it grew was really good news for decades. Now, we've got something called an RMD, starts at age 73 at the moment. I think that one's going to get kicked to maybe 75 in the near future. But the very structures of these plans that you've been contributing to and your employer's been putting in as well were great. They just became your worst enemy because of, let's say, hitting age 75. And if you don't tackle this problem today, remember that in general, these big asset pools are going to double every 7 to 8 years. So let's just, you're 55, you got $1 million, and there's 20 years to age 75. That means you're going to have 8 million when you're 75 years old, because it's going to double twice. Once to twice, you get the math. And all of a sudden, you can stand there at age 75 and say to yourself, now I got two problems. I've got required minimum distributions that look like $300,000 a year, which just blew me through about 6 tax brackets from where I was. And I'm nudging up against the federal estate tax exclusion, which is currently just a touch under 14 million. Now, lots of people won't face this, but there's a solution to which you hinted, but it needs to be launched not necessarily in your 50s, but certainly in your 60s, which is the free period from age 60 to 75, of saying, I'm going to build a layer cake of Roth conversion layers. Now, there's a theory and good math on, well, how big's a layer? Should it be 5,000, 10,000, 50,000? We can figure that out. Now, can you start earlier? Sure you can. If you've got a set of plans providing income and you're saying to yourself, and I got something left over. Should I start Roth conversions in lower tax brackets in my mid-50s? The answer is yes, if it's there. If it's not there, don't worry about it. Let's get through this box of the fixed plan 5-year set of rules, hit that 59th and a half or 60th birthday, shut the plans down, replan, and definitely build in 15 years of Roth conversion layers.
I have a question, please. So we talk about 45 to 55 being the sweet spot, give or take. Should you start a 72T exception for SEPP plan after 55, or is that a moot point because you're going to turn 59 and a half? And what happens to a 72T plan if you start it later and it extends beyond 59 and a half?
Well, I got a multi-part answer there. If you just turned 55 or you just turned 56 or maybe even 57, no big deal. Go ahead and start the plan. even though it's going to stretch beyond 59 and a half to hit the full 5 years, meaning 5 times 365 number of days. By the time you're in your 57, then I'm going to challenge you and say, do you really want to start a plan that is, you're, so to speak, you're going to be fence straddling with 2 years hung down below 59 and a half and 3 years above 59 and a half? You're almost better off looking for a different source of income, including just even borrowing your living expense to hit the 59th and a half birthday, so that these rules don't stretch until you're, say, 62 and a half or 63.
Yeah, so that makes sense. And the reason why Bill is asking that question is because, remember, one of the rules of the 72T is that it has to continue for 5 years or 59 and a half, whichever is longer. So if you're starting it at 57, then you have to do it for 5 years. And then when we are mentioning the acronym SEPP, that stands for, Bill, Jan, what does SEPP stand for?
Substantially equal periodic payments.
Okay,
Yes!
Great. Yes, you got it right. Yay. Ding, 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 ding. So just sometimes when we use acronyms and stuff, people are like, what are they talking about? Especially if they skipped over a section. So I just wanted to just have a reminder of that. So I guess what I gather from what you're saying, Mr. 72T, is that the IRS Rule 72T and Roth conversion ladder, those do not have to be mutually exclusive. You can actually use them in conjunction with each other. You can use both of them. It's not one or the other. It doesn't have to be.
Sure, because in general, the whole concept, I mean, thank God for Senator Roth in 1998. Right. That's why it's called a Roth conversion.
Right.
Or a Roth IRA. The whole game plan in Roth conversions is tax bracket management, which is a lifetime issue, not 10 years, not 20, not even a little 5-year. And we're talking about SEPP plans, that's just a short-term issue to hit 5 years or 59 and a half. And you'll get there quick enough and then tackle Roth conversion layers head on. The target being that at least from 60 to 75, you put in place a regimen that on your 75th birthday, you're standing there and you say, oh, look at this. Remember 15 years ago when 90% plus of my liquid investable assets were in deferred accounts, IRAs, the 401ks, etc. The teeter-totter was tilted like this. And then each year, you cause the teeter-totter to change until on your 75th birthday, you go, gee, I don't have any RMDs. You say, well, why not? He says, because my IRAs are gone. All I got left is after-tax accounts and Roth.
Yeah, you're not coming to that tax bomb. And we'll probably do another episode wholly on Roth conversions.
Oh, sure.
Folks, I want to warn you that we want to make this a comprehensive 72T episode. So we're going to go a little long today. So stay with us.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our social media maven is Diana Falk, and our editor is Fritz Brizard. We love them, and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofi.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to Fi. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to 5. Cheers.